Hi, everyone. Welcome to the next webinar in our series, which is Cash Flow Planning. My name is Marisa Kubasic, and I'm a Senior Associate with the Nonprofit Finance Fund. I'm joining you from Los Angeles. Before we begin, we'd like to start with an acknowledgement of Indigenous territories. We are all joining from different physical locations, and we find that it's really important as a part of our own journey as an organization that is, really specifically working with community-driven organizations within BIPOC communities and becoming an anti-racist organization, that we want to acknowledge where we're situated, not only literally and physically, but also historically, and honor that, we are on previously owned by Indigenous territories, and that, this is a way of restoring balance and justice to the true history of where we are and where we're joining from. So we invite you to look up the Indigenous territory that you are joining from. I am personally here on Tongva land. And we'll just give you a moment to look this up and think through, what territory you're joining us from. A little bit more about the Nonprofit Finance Fund. We are a 40-year-old nonprofit. We have offices across the country with about 100 staff. And we're really aiming to directly address and correct systemic and institutional issues of racism that have prevented communities of color from getting the money and the resources that they need. We want to help community-centered organizations access capital, financial knowledge, the resources that they need to realize their aspirations. We do this in a variety of ways. We provide loans to nonprofits. We also offer financial consulting. We work with both nonprofits and funders in this way. We also share the insights that we've learned from working so much in this sector. And ultimately, we're building a movement that shifts funding and financing practices so that more money flows with less restrictions to community-led organizations. We are almost at the midway point of this webinar series. So these are a few of the faces that you're going to see and the people that you're going to be hearing from as we progress through the rest of the webinars. We have Michael, Alice, Annie, and Jonathan, all of them experts that'll be working with you on a variety of different topics coming up. Today, like I said, we're going to be talking specifically about cash flow projection. And with that in mind, we have a few different learning goals here for you. Our hope is that by the end of this session, you will have learned how to create a cash flow projection tool. We're also hoping that you'll understand common strategies for managing cash flow and also recognize common missteps and how to avoid them. We'll also hope that you will identify the differences between cash and accrual accounting, and that you'll understand how cash flow management connects to accessing credit. Before we dive in, we want to revisit this particular visual. This is this, way of us talking about, the overall financial health of an organization. And you've probably seen this before in previous webinars. On the one side, we have that orange business model thinking about, are you able to cover your costs, whether or not you're generating consistent surpluses, which then fuel, the health of your balance sheet, thinking, do you have access to enough cash, which then, of course, allows you to reinvest into your business model. Again, that regular recurring costs and revenue coming in. Today, when we talk about a cash flow projection tool, it really exists within the context of this orange piece, right? This business model. We're going to be thinking through what is the cash coming into your organization at any given time, and are you able to cover your regular and expected costs? And what do you do if the answer is no? Or what do you do if the answer is yes? Before we get deeper into the content, we have a few reflection questions here to just get ourselves thinking about, all the ways in which we interact with cash flow. And what are the sorts of like questions and challenges that come up for you? So the first question that we have here is, when it comes to thinking and talking about cash coming in and going out of your organization, what questions come up for you? The second question is, how does your organization's cash flow impact you, your team, and your organization? And the third question is, what tools have you used to track cash flow before? What was helpful about them and what was challenging? And I'm going to go ahead and give us a few moments to jot down just quick answers, reflections in response to these questions here. All right. So I am going to continue moving forward, but if you're really in a groove and you want to keep jotting down your responses, feel free to hit pause and then rejoin. But hopefully, we've started to think through some questions or some ideas that we will address throughout this presentation. So what is cash flow? Well, cash flow and also a cash flow projection tool, it's a financial representation of anticipated cash coming in and cash going out or cash spent. It hopefully creates a visual landscape of this cash flowing in and cash flowing out. It shows whether there will be enough cash on hand to actually pay the bills at various points over, say, the month or the quarter during a fiscal year. By developing this visual landscape of cash flowing in and out, you can have more certainty about whether and when cash will be available to meet future operating needs when they arise. A cash flow projection tool can start to identify what's a cash flow issue and what's a cash issue. And what we mean by that is, when you have a cash issue, that means your organization fundamentally doesn't have the resources required to deliver on your mission. So maybe you lost a source of funding. Whereas a cash flow issue is a timing issue. So in that case, the cash is coming, it's just not here yet. It's an important distinction because these two issues require very different strategies, which we will talk about later. So getting some visibility into these low cash moments when you're using a cash flow projection tool is key, because what it can do is help you think through, how will we address these possible issues in front of us? What are some of the actions that we can take? We're also going to sort of set the foundation by talking through two different terms that come up a lot when you're looking at a cash flow projection tool. We often will refer to two different approaches to accounting. One is cash accounting, and another is accrual accounting. And you may have encountered these terms or be familiar with one or the other. So we want to make sure that we sort of set that foundation and get on the same page about those terms. So cash accounting is an approach to accounting that's really similar to balancing a checkbook, right? You're measuring the cash coming in and the cash going out and recording it when the cash comes into your bank account and when the cash is spent. It's really common for smaller sized or more straightforward organizations. Accrual accounting is different. It's a lot more comprehensive and looks at revenue when it's earned and expenses when it's incurred, meaning you're recognizing revenue when you are awarded the grant, but maybe those funds have not hit your bank account yet. or you're recording expenses when you've received an invoice, but you have not paid that invoice yet. And so in this way, revenue and expenses, especially when we're talking about accrual accounting, are not necessarily always equal to cash. Cash in is not always the same as revenue recognized, and cash going out is not always the same as expenses recognized. Cash in is cash in the bank. Cash going out is cash spent. We also like to make sure that we clarify the difference between a cash flow projection tool and a budget, right? These are two very different things as well. Budgeting is definitely related to cash flow planning, but it's not the same. A budget looks at, what are you hoping to achieve in the year in total, right? How are you looking at the entire fiscal year and what you anticipate achieving and spending? A cash flow projection tool, however, that slices up your projections by increments of time so that you can zero in on and potentially identify cash flow challenges that might occur during the year. It's really rooted in the timing of that cash coming in and that cash going out, right? It's not the same as a budget, which again, that looks at the year in total and can't really give you that insight into any particular timing issues. If your organization uses cash basis of accounting, the budget will represent total cash in and going out for the entire fiscal year. It really can't show you those monthly ebbs and flows. When you're getting ready to set up a cash flow projection tool and start thinking through that timing, you do want to use your current budget as a reference. And you also want to look at the previous year's checkbook and any kind of historical cash inflows and cash outflows. I'm going to show you now what this tool could look like. And right now it might look pretty intimidating, but I promise we're going to break it down and we're going to dive into more detail together because I want to show you what this could look like and how it can give you insight into any particular cash flow issues and ways to respond to it. So this is a slice of a cash flow projection tool. And I'm going to walk you through the different layers of detail. And I just want to point out that some of this might be relevant to you right now, and some of this might be more relevant to you in the future. The first thing you want to notice is that the cash flow projection tool is always divided up by increments of time. It could be quarterly, it could be monthly, it could be weekly. Some organizations have even gone down to daily. This particular organization has sliced it up by month. So they're looking at monthly increments. The next thing I want to show you is that you're always going to account for your beginning cash balance. This organization has two beginning cash balances, and I'm going to explore what that means with you in a moment. But essentially, they're looking at their total cash balance, so cash that they have that doesn't have any restrictions, cash that might have restrictions, and cash that might be outside of their regular operations. And then they're also zeroing in on what kind of cash is a part of our regular operations and doesn't have any restrictions. You'll see that down here, this organization has really tracked very carefully what's the kind of cash coming in that is ready, available, and doesn't have any kind of restriction tied to it, and what are the kind of expenses that we can anticipate spending that cash on. It's also teased out or separated out what is the cash that we have that does have restrictions on it, and when can we anticipate any kind of releases of those restrictions? As you might recall from before, when we're talking about cash with restrictions, that could be because of a purpose or because of a timing restriction. So it could be that it's specified for a particular program, or it could be released on a particular schedule. This organization has also added a layer of detail about non-operating cash, meaning those one-time occurrences of cash received and cash spent that are outside, regular operations. So in this organization's case, they are looking at, a capital campaign and capital expenses. And then at the bottom here, you'll see that they're always tracking what is our ending operating cash balance without restrictions and our ending total cash balance. They're looking at their cash balance that's ready and available at the end of all of these activities throughout the month. And they're also looking at what is their anticipated bottom line or their anticipated total ending cash balance. So let's look at this in a little more detail. Let's start with the absolute basics. Let's look at those mechanics. So this is an even smaller slice and a much less detailed version of a cash flow projection tool because we want to help you understand the basic mechanics. First, what you'll see is this organization has separated into months again, and they have their cash listed out in thousands. They've started with a beginning cash balance of $120,000. And then underneath that, they've listed what are all the different sources of cash that they can anticipate. So for this organization, it's ticket sales and a foundation grant, but there might be a lot of other different types of sources that you could write down here. And then they've tallied and totaled it here. Then they're thinking through what are the different ways in which we are going to spend our cash? What are the different ways that we are going to use it in service of our mission? So that's where they've listed out the different ways that they're going to spend their cash. You'll note that this again is really zeroed in on cash. We're not thinking about depreciation or in kind because we're really focused in on cash going out. And they've totaled up their total cash spent. When they've taken their total cash in, which was $150,000, and then subtracted out the total cash spent, they're left with a net cash of $20,000. So that's how you figure out what your net cash will be or what's left over after all of the activities in this particular month. They have subtracted cash spent from cash in. Then they've taken that net cash in and they've added it to their beginning cash balance. So they started with $120,000. After all of the month's activities, they had $20,000 and they've added it to $120,000. And that's how they've arrived at their ending cash balance, which is $140,000 in their ending cash balance for the month of January. That ending cash balance of $140,000, that then becomes the new beginning cash balance for February of $140,000. So what does this look like when we add in another layer of detail? So now we're looking at this organization, but they want to say, okay, we know we have a beginning cash balance of $120,000, but how much of this is ready, available, it doesn't have any restrictions on it, and how much of this is actually restricted? So this organization has added in this new layer of detail of tracking their cash balance without restrictions and their cash with restrictions. So you'll see they have two beginning cash balances here. Beginning cash balance in gray, that's their total cash balance. And then in orange, they have beginning cash balance without restrictions, and that's that cash that is ready, available. It doesn't have any kind of restriction or constraint on it. They can use it as they see fit. So again, they've listed out the different anticipated sources of cash in without restrictions. They've also anticipated their different expenses. So they have $120,000 in total of cash in without restrictions. They anticipate that they will spend $130,000, and that leaves them with a net of $10,000. You'll also notice that when we're looking at the different sources of cash without restrictions, there's a new line that says net assets released from restrictions. So in this regard, they're tracking what cash that was previously restricted has been released because we fulfilled the timing or we have fulfilled the purpose. We want to be sure that we track it here. So you can see that they were left with $10,000, negative $10,000 of net cash without restrictions. And to make sure that they're tracking accurately their ending cash balance without restrictions, they've taken $100,000, subtracted out that $10,000, and they have an ending cash balance without restrictions of $90,000. So again, we're really just zeroing in on what were the activities of the cash in without restrictions, what was the net, And how did we arrive at that $90,000 here in the orange of the ending cash balance without restrictions? That ending cash balance without restrictions then gets moved up to being the new starting or beginning cash balance without restrictions for February. So we've just really zeroed in on cash balance without restrictions. Now we're going to look at cash with restrictions. Here you can see that the organization has separated out what is the cash in that they anticipate with restrictions on it, either for purpose or timing. And they've also tracked that cash released from restrictions. So whereas before in without restrictions, we tracked it as positive $10,000, this organization has made sure to subtract it out from the section of cash with restrictions. They've gone through the same process of tracking, okay, what is our cash in? $40,000 with restrictions. What was the cash released? It's $10,000. And that's how they've arrived at net cash with restrictions of $30,000. So we had our net cash without restrictions of negative 10,000, and we had our net cash with restrictions of 30,000. To arrive at the total net cash, we're going to take those two nets, add them together, and we'll arrive at total net cash of $20,000. So you're looking really at those nets, net cash without restrictions, net cash with restrictions, to get at your total net cash. We're going to add it back to that beginning cash balance, and you'll see that the ending cash balance in total of $140,000 is now the new beginning cash balance. What's really interesting to note about this particular organization is that whereas they have an ending cash balance of $140,000 in total, that becomes their new beginning cash balance, actually have $90,000 available without restrictions. So whereas in total it looks like a lot more, what's ready and available for them to use on their regular operations is less. So now we're going to move on to looking at another layer of detail when tracking your cash flow. We've added in this detail of cash with and without restrictions. And our next recommendation is to also separate out, if you have it, your operating cash from your non-operating cash. If you'll recall, when we're talking about your operating cash, we're talking about regular, reliable sources of cash coming in and regular, reliable expenses that you will incur. So things that are part of regular business model operations. If you have something like a bequest that you've received or a capital grant, that one-time revenue that you just can't anticipate in regular years, we always recommend that you separate that out below the line and track that as non-operating. So what does that look like here? Well, again, this organization has their beginning cash balance at the top. They're looking at the cash balance in total, and they're also looking at operating cash balance without restrictions. So cash balance that is a part of regular operations and is ready and available for them to use without any kind of constraint or restriction. Again, they've listed out their cash sources, and they've accounted for their different types of ways they're going to use that cash. And they have arrived at, total operating cash spent as $90,000. They've subtracted $90,000 from their total cash in of $70,000 and arrived at a net operating cash without restrictions of negative $20,000. We've really condensed the detail about the net cash with restrictions that's come in, but just know that their net was $30,000 after they accounted for all of their activities. And now we also have this additional layer of tracking their non-operating activities. So they're looking at a capital grant that's coming in, an expense of $40,000, and they have a net non-operating cash in of $10,000. So just like before, this organization made sure to track, okay, we have our operating cash in total 70,000, our operating cash spent total 90,000. That gave us a net of negative $20,000 of operating cash without restrictions. They've added that to their beginning operating cash balance without restrictions to get 80,000, and they've put it up in February as their beginning operating cash balance without restrictions. Now they're also going to try to tally up the totals by looking at all of the different nets. So they're looking at their net operating cash without restrictions, that's negative $20,000. They are looking at their cash with restrictions, that's positive $30,000. And they are adding in that net non-operating cash of $10,000. So negative 20 plus 30 plus 10, that gives them a total net cash of $20,000, which they've again added to their beginning cash balance of $120,000, which means they've had $140,000 in their ending cash balance and moved it up to the top of the beginning cash balance. So again, it's the same principle of, accounting for all of your activities in the different categories, operating without restrictions, with restrictions, and then non-operating, adding up all the different nets, and really making sure to track separately your total beginning cash balance and your beginning operating cash balance without restrictions. Again, really interesting to note that once we've added in this layer of detail of separating out non-operating cash, this organization has a beginning cash balance, again, of $140,000, but their beginning operating cash balance without restrictions, again, ready, available to use, and a part of regular occurring business activities be $80,000. If you'd like to start experimenting with this particular cash flow tool, look at the template and really dive into it, you can access that particular template with step-by-step instructions at this website. Our website has a lot of different tools that you can use, and this is ready and available for you. So we've put together a lot of different pieces of the cash flow projection tool, and now we have this organization's cash flow projection tool for the entire year. This organization has layered in all the detail we've talked about. They've separated out their operating cash from their non-operating cash. They've separated out their restrictions from cash without restrictions. They've projected out activities by looking at their historical records and also looking at their budget to say, what can we anticipate coming in each month of the year? What can we anticipate spending? And what's really, really interesting about this is when you look at the absolute bottom line, the ending cash balance, this organization is doing well. They have surpluses across the board, right? But if we really look at just that operating cash without restrictions, we'll see that in the months of July, August, and September, this organization is looking at potential shortfalls of cash that is available and ready for them to use, right? They're seeing that these months might feel pretty tight because of the timing of the cash that they can anticipate. So, because they've gone through the activity of mapping out when they anticipate encountering these particular issues, now they can say, oh, it looks like the summer and the early fall, that's going to be challenging. We might experience some cash flow issues. What are some of the things that we can do? What's the plan that we're going to put into place to address this issue? So now we're going to move into talking about some of the strategies that this organization could consider in addressing their cash flow issues. There are a lot of different options available, and we're going to walk through several of them today. We're going to spend a lot more time also talking about, what it means to borrow cash or to seek out loans. The first option available to nonprofit organizations is access existing cash. And so we're talking about cash reserves, rainy day funds, cash that you've set aside in case of an emergency. Another option is to talk to funders about potentially easing restrictions on existing revenue, lot of organizations in times of emergency, their funders have said, okay, in this particular case, we're going to lift this particular restriction. It's now in this moment, general operating support. So engage in that conversation with your funder. Another option that many of us are familiar with is do not spend cash. And in this way, you can talk to vendors and lenders to talk about a payment plan or the timing of when you're going to be spending your cash with them. Another option is to look at minimizing expenses. Organizations that may have pivoted from an in-person programming model to a digital or a virtual one might be looking at ways that they can minimize, for instance, office supply expenses or printing expenses. Oftentimes, organizations will look at personnel because that is the largest expense for a lot of organizations. When you're doing that, really think through, what are all of the different implications? Could we just not fill open vacancies? How do we talk about this with staff? It's an opportunity for you to really think about when you're minimizing expenses, what are our organizational priorities and how are we going to use them to inform the ways that we cut back and not spend cash and how we communicate about it with our staff and our supporters. Another strategy is receiving cash. And we want to be really clear that this is not so much about starting a new campaign to get more cash, but rather maybe you can approach funders and talk about accelerated or advanced payments. Maybe you could move up the timing of a particular event. Maybe you always do a special kind of fundraiser in one part of the year. Maybe you can look at moving it to a different part of the year. Could also look at converting funds. So maybe you had to cancel a show. Could that ticket revenue from the canceled show be converted into a donation to the organization? And the last strategy that we're going to talk a little bit more in depth about is borrowing cash. And borrowing cash is, maybe drawing on an external line of credit or receiving a bridge loan. What we want to make really clear is this is oftentimes historically used to address a cash flow and again, cash timing issue, right? The cash is coming, but you're not sure when, or it's not at the right moment to address the cash flow issue. That's different from, again, remember that cash issue where you really do have a loss of funding. It's not going to come back, right? When you are considering taking on debt or borrowing cash, really think through, is this a cash flow or a cash issue? And if it's a cash flow issue, that might be where it's time to start thinking about it versus a cash issue that might have stronger implications for the health of your organization. But if you are in a place where you think that borrowing cash is an appropriate response to your cash flow issue, we want to delve a little bit more into detail about what that could look like. So we're going to talk about two pretty common approaches to using debt to address cash flow issues. First is line of credit, and the other is a bridge loan, right? So when you are accessing a line of credit, that can really help to address periodic or recurring cash flow issues. It's something that you see that's going to happen in a particular period of time or come back up again. And it helps you get that cash for those timing gaps between the disbursement and the receipt of cash. You do have to be mindful of the fact that monthly interest is paid on outstanding balances. And if you're not using that particular line of credit, there is a non-use fee paid. So something to consider. And that's where, again, that cash flow projection tool is really helpful because you can think through, will we have enough cash on hand to address the monthly payments as well as the non-use fee should we decide to not use the line of credit in particular moments. The other option that we're going to talk about is a bridge loan. And a bridge loan is historically used to address a timing gap from a specific source. So for instance, maybe you've received government funding, you have not received it yet, you need to close that timing gap, right? Or maybe you had a particular event, you're waiting for the receipt of those funds from that particular event that you held for fundraising. It's used to cover the expenses until that source of funding is received. And in the meantime, principal repayment is required upon the receipt of those funds, and you are paying those monthly interest payments. So again, that's coming from your operating cash flow. And that's why it's really helpful to zoom in on the detail of what is our operating cash without restriction available. Would we be able to cover those monthly interest payments? When you are looking at and considering taking on debt, there are certain opportunities and considerations to keep in mind, right? The opportunities would be that you would have, access to a greater amount of cash than you would through philanthropy alone. And that access to capital, it's faster, it's more flexible, there aren't restrictions imposed on it. So it does give you that sort of, agility. And there's a better rate available to nonprofits, oftentimes through a government or a mission entity. Considerations to keep in mind, you do want to know, do we have the staff capacity? Do we have the time to be able to successfully complete a loan application? Do we also have the capacity to manage the loan payments? Who would be monitoring that? Who would be responsible for it? And do we have enough operating cash on hand to be able to cover those loan payments? And if you're a smaller organization, it's also important to think through, it is a lot more difficult to secure a loan without collateral. And finally, you may be seeing this as an opportunity to take on debt, but other folks within the organization may not agree. There might be some internal resistance to taking on loans and the implications that would bring for your organization. So you may need to talk this through with your board and with staff as appropriate. Oftentimes, what happens when you have walked through putting together your cash flow projection tool, thought through where you might run into cash flow issues, and considered that there are a lot of different possibilities to address it, there are a lot of questions that come up. And these are some of the more frequently asked questions that we have received over time. What are going to be the greatest challenges? What activities are core to our mission, and how do they impact our cash flow? What are my non-negotiables? How might I be impacted by the economy and external factors? What can be delayed? And what kind of changes will, how will these changes affect our reserves and our ability to manage future cash flow, right? These are just a sampling of some questions that come up. And what you can do is you can use the data that you have in your cash flow projection tool and the questions that arise to engage in conversations with, different departments, different staff members, leadership and board, to think through these kinds of questions, right? To arrive at what real scenarios might we encounter together, knowing that we might run into these particular cash flow issues. Once you're engaging in those conversations, then you can start thinking through how to make very specific strategic decisions to address them. You can really think through with those questions and with that data in front of you from the projection tool, what are the implications of the decisions that we make, specifically if it's to, move the timing around of events or seek out new funding. You really want to think through and understand different types of scenarios, and really think through the impact on everyone involved and really engage everyone in conversation around this, so that you can make a thoughtful plan, especially if you're forced into, a response or a scenario that is rooted in, a bigger emergency. You also want to think through what are the different triggers that are going to lead to us activating different types of plans that we've developed, right? So maybe you've thought through the different scenarios, you've thought through the implications, and you've crafted, plan A, plan B, plan C. Well, what's going to indicate to you that you need to activate those different plans? Is it that you haven't received a certain percentage of revenue by a specific time? Is it if, particular, grants, the resources don't arrive, what are going to be those triggers for you? Hopefully, as we've moved through this webinar, you've really learned how to address these cash flow issues. You've moved through these learning goals with us. You've learned how to create a cash flow projection tool. You've thought through the common strategies for managing cash flow and thought through those different missteps and how to avoid them, by way of like looking at what a cash flow projection tool looks like in practice. We hope we've made more clear, the differences between cash and accrual accounting. And we also hope that we've helped you understand how cash flow management connects to accessing credit and thinking through the different implications of that decision for your organization. As we've come to the close, we want to think through we like to say, we're closing out with, either a reflection from the head, the heart, or your feet. So what did you learn from today's session? Or how did today's session make you feel? What sorts of actions will you take to bring back to your organization and your community? So I'm going to give you a moment to sort of think through, one of these or maybe all of these, thing that you learned, or how it made you feel, or an action that you'll bring back, an action that you'll take. So give us a moment. All right. So we have a few upcoming sessions after this that we want to make sure that we show you. So right now you're at cash flow planning. Coming up, we have strategic budgeting and scenario planning, and understanding your money and mission matrix, telling your financial story. Next is telling your financial story. So with Michael, thinking through, what are the different parts of your financial story and how do you tell it to your different audiences in a way that really supports you in advocating for your organization's needs. So that will be led by Michael Cass. And we just want to thank you for participating in this. We hope that it's been helpful with you in thinking through, that very specific cash flow part of your regular operations. If you have any questions, please do reach out to us. Here are the different ways that you can reach out to us with any sort of questions or insights that you have. We really want to thank you for participating in this, and we really appreciate having you here.